Will bank supervision get less subjective? And what could that mean for your money? The Federal Reserve just moved to formally drop reputational risk from its exam framework, and that shift matters for banks and investors. Here's the context. For years, examiners sometimes flagged reputational concerns, like public perception or brand damage, as a standalone risk. Those judgments could be hard to quantify and uneven across institutions. The Fed now wants to codify earlier changes and make clear that reputational risk won't be used as a separate category in exams. The first key insight is focus. Examiners will center evaluations on measurable safety and soundness risks: credit, market, liquidity, operational, and compliance. If a publicity issue threatens deposits, funding costs, or loan performance, it gets captured where the numbers show it: liquidity stress, credit deterioration, or operational breakdowns. The label changes, but the underlying risk still counts when it affects resilience. The second insight is clarity. Banks get a cleaner line of sight into how judgments are reached. Instead of open-ended criteria, supervisors are aligning language and expectations with established metrics and data. That makes it easier to design controls, set risk appetite, and explain decisions to boards and investors. Third, consistency improves. Removing a subjective bucket reduces room for interpretation that can vary across exam teams or regions. More standardized assessments can support predictability in ratings and remediation timelines, which feeds into capital planning, funding access, and pricing. Fourth, the change does not loosen standards. It refocuses them. Institutions still must manage issues that could harm franchise value, but they need to evidence the pathway to safety and soundness implications through concentrations, underwriting quality, rate sensitivity, deposit stability, contingency funding, operational resilience, or compliance effectiveness. Finally, markets should watch the downstream effects. Clearer rules can influence lending posture and product offerings by lowering uncertainty costs. They can also affect how banks evaluate higher-profile clients and sectors, with decisions grounded in quantifiable risk rather than perceived headlines alone. For equity and credit investors, this may narrow the gap between narrative risk and financial risk, aiding valuation and comparability. Practical takeaway: expect exam materials, policies, and training to be updated. Watch for how banks translate this into risk reporting, governance, and disclosures. Look for signals in net interest margin sensitivity, deposit mix stability, credit provisioning, and operational metrics that now carry more weight. Read the full article at finlitica.com.